Let's discuss this further with Vicky Pryce, who joins me now from London. She is an economist and a board member at the Center for Economics and Business Research. Vicky, good to have you on the program. So explain to our viewers, I mean, the main reason why we're seeing a weaker pound is that international investors basically have been spooked by the government's decision to make these sweeping tax cuts.
I think, as your reporter was showing, the pound has been falling for quite some time. So from the beginning of the year, we've seen this decline sort of accelerate, if you like. So even before this latest mini budget, which was last Friday, which put this extra money into the economy, which was quite unexpected in terms of its size, we had seen that the markets had already downgraded, particularly the growth forecast for the UK economy. So they expected it to actually be one of the ones worst hit by the energy crisis and to have one of the slowest growth paths, if you like, next year. Now, this has been now reevaluated even more because what's going on right now, of course, is that because of those higher interest rates, which we're already seeing in the markets as a reaction to this extra funding, which has come through or will be coming through over a period of months. Because remember, some of those tax cuts and postponements of tax increases are not really having any effect until next financial year, starting in April. But the expectation is that they may well be inflationary. They are unfunded in the sense that there isn't any tax increase behind it to satisfy the markets, that this is a prudent fiscal move. And therefore, they are now punishing both the bond market, where yields have gone up very significantly, and of course the pound, which looks like it's a little bit on the high side, because inflation is going to be considerably higher than they had anticipated originally.
So that's the markets, that's the macroeconomic side to it. I mean, how is this going to affect consumers? Because businesses in the country that import and export goods are going to be thrown into disarray, and that's certainly going to affect consumers.
Yes, I mean, the real worry thing is that because we're already entering a slowdown, in fact, the Bank of England has been expecting that this quarter, where we're still now in September, is going to see a decline as well in GDP. So we'll have a technical recession, 2 quarters of decline in GDP. Already the mood was worsening. Consumer confidence has been declining very significantly. And now you have this interest rate increase. This means that for people who have managed to have mortgages which were at 1%, 2%, 2.5% before, we'll suddenly see the repayments increase very, very significantly if they are on variable rates of mortgages. And if they are on fixed rates, 75% of people have 2 5-year mortgages, which have fixed interest rates. When they have to go and renew them, they will find that they have increased hugely, which means that for many, instead of paying, for example, £150 a month for the mortgage, they might end up paying more like 500, even 700 is what some people are concerned about. So the cost will, for many, double, if not treble.
The International Monetary Fund has issued a statement saying that it is concerned. I mean, isn't it a bit ironic that the IMF has urged the country to sort of reevaluate its tax cuts, but at the same time it has been criticized for unfair lending practices in other developing countries?
There has been a bit of criticism of that coming through UK politicians sort of today, that perhaps that attack, if you like, on the UK's policies is unwarranted. I mean, the reality is that what we're seeing across the world is interest rates going up and therefore a slowdown in world growth. What we're also seeing, of course, is that developing countries are suffering because they borrowed a lot in US dollars, which have been going up. So we mustn't forget that. But I think what is true is that what the IMF has been saying for a little while now is that what we need to do is be very, very careful about re-establishing growth, if you like, after the energy crisis, and cut energy demand. That suggests that they wanted, in fact, and they've spelled it out, both a tighter monetary policy on inflation and also be very, very careful on the fiscal front, but of course balance that in a sensible way. What in the UK seems to be happening is that we've abandoned the second bit, if you like, and are now this whole thing has come on its own. It's come also with a price freeze for energy, which is going to cost the government considerably more than the £45 billion that they are injecting in the economy through tax cuts.
Okay. Vicky Pryce, always a pleasure talking to you. Thank you for joining us here on the NewsHour. I do appreciate it.